Hi guys, Dr. Robinson. It's March 4th, 2023. This is the weekly update of the Money Masters Investment Club. So our itinerary this week, guys, a little different than normal. And that's the reason for that is to mitigate risk while the market is so unpredictable. Trading was suspended last week. So for most of last week, I haven't done any trading simply because the market is too unpredictable. And what I want to share with you is that when I say the market is unpredictable, we tend to think short term in terms of we're buying daily options, options that expire on a daily basis and stuff. And when we talk about trend lines, because trends are everything to us, when it comes to the longer term trends, and I'm not talking like a week or a month trend, I'm talking about a daily trend. But when we look at a daily trend, the trends, and I showed you this last week in the charts that I had posted last week. The overall trend is not that hard to find and to stick with. The problem is these huge retracements we're going through. And it's these retracements that keep posing problems here. And what I mean by this, if you're not fully understanding what the chart showed last week, remember when I get into a trade, let's say for example I do 1,000 contracts and I get into a trade where it's calls and we go up. We might be up 10, 15, 20 cents. And then the market goes through this weird thing where right now it may retrace, but normally when the market retraces, it retraces 10, 15, 20 cents. So you may have been up 20 cents, but now it's come back down. And the reason that does this, by the way, is that, and we call this, if you come to our daily calls, we call this a recharge. Shorter charts kind of have to recharge a little bit because to move the market up, the short charts have to turn up and keep going up to turn some of the longer charts up because the longer charts may have been heading in the different direction or may have been flat. So to keep doing that, it has to go up. But you get a little bit of exhaustion when you do that. Um, in the market, whenever the market kind of goes up for any length of time, it has to go through a period. We call it in finance, we call it consolidation. It has to consolidate. And I liken this, the way I used to teach this in colleges, it's kind of like running uphill. If you run uphill, you can run real hard for a bit, but at some point you're going to have to stop and catch your breath. You can't just keep running straight up the hill all the way to the top of the hill. Let's say the hill is a mountain. You can't keep going head on all the time. You're going to have to stop, kind of put your hands on your knees, kind of bend over and kind of catch your breath. Well, the market does the same thing. We call those retracements. And when a retracement comes, usually the market doesn't come back down any further than where you originally got in, and rarely even that far. For example, if I'm up 20, 25 cents on a trade, if it retraces, it might come down 10, maybe 15 cents. But that's usually about it. And then it catches its breath, the market catches its breath, and it pushes on, and it goes up another 15 or 20 or 30 cents. And then again, it does another consolidation. And you can see those consolidations on the short charts, by the way, on a 2 and a 3 and even a 5-minute chart. So you'll see this where those things want to try to turn over a little bit, and maybe they turn red for a moment, and then they go back to green and start heading back up. Those are the consolidations. That's the market catching its breath. But lately, what's been happening here, and this has been happening for about the last month or so, these consolidations are not coming down 5, 10, or 15 cents. They're coming down 70, 80, 90 cents. So what happens here is we buy 1,000 contracts, we get into a trade, we're up $20,000, $30,000, and then what happens is you immediately get some red candles and they come down, and the next thing you know, and it's just seconds later, you're down 40, 50, $60,000. And now what you have to start thinking about is, do I take my loss? We had a gain, you didn't take the gain because the market looked like it was going to continue going up, or you were maybe expecting a small consolidation. It doesn't happen. You get a big consolidation to the downside, and now you've got to make a decision. Take the loss, which I rarely like to do, or hold and ignore it, which is really hard to do. The last option is to strangle the trade, buy some puts to protect yourself on the downside and hope that the market kind of settles down and can get you, in a position where you can, profit either way. The problem here is what's happening here is that these retracements are so big that by the time you realize the market is turning and all your other charts have turned, you got to buy some puts in this case. But now you've bought the puts, and now the market kind of settles down and starts going back up. And now you've got positions in both calls and puts. Now your calls are way out of the money. You've lost 30, 40, $50,000, maybe 60,000. And now your puts are going to be moving in the wrong direction too. So now you're in a trade where you're basically trapped. You can't make money on either side of the trade simply because you're in such a bad position. So you're trapped in this trade. So what we have to do generally is kind of wait it out a little bit to see, and eventually you're going to have to decide or make a decision to cut one side loose. The problem here is that when you're in the middle like that, you don't know which way to cut first. You don't know whether to cut the calls. You don't know whether to cut the puts. So you try to give the market a little bit of time to settle down so you can kind of go back to the trend line. But those trend lines, especially when you're caught between those two spots, it's hard to see because you start to have to go into a smaller or shorter chart to kind of get an indication of which way the market wants to go. To avoid that, and that's what caused our big losses, in the last few weeks. We get trapped in those two positions, and we can't get out. So to eliminate that risk, I decided last week I got to get out of the market here for a while until the market can kind of calm down a little bit, until we can get direction one way or the other. Now, some people have asked me what is causing all these huge retracements. What's causing it is primarily the Fed. The Fed has had a bunch of speakers over the last few weeks, and they keep talking out in the public, and they keep doing something I think is unethical. And I actually wrote a letter years ago to the Fed and told them that this is unethical, what I think that they do, where they talk during market hours. If the Fed is going to come out and say, hey, we're going to raise interest rates, or we're not going to raise interest rates, they should do that when the market is not open. There's no reason they can't do that before 9:30 in the morning or after 4 p.m. in the evening. But they do that during the market while the market's open. Now, small-time investors or retail investors are at disadvantage when this happens because we don't have all the algorithms that the big boys have, the Merrill Lynch's and the Goldman Sachs and all of those companies. We don't have the algorithms that look just for words coming out of the Fed. We have algorithms, but our algorithms are all mathematical. They're all about the market. So we don't get to see when the Fed says something stupid, or when this speaker comes out and says this, or that speaker comes out an hour later and contradicts it and says something else. We're at the mercy. So what's happening here is that there's so many speakers right now because the market is so in tune with what is the Fed going to continue doing about interest rates. Now, you and I all know, because we're all reasonably intelligent, we all know the interest rates are going up. There are a lot of people, in fact, Wells Fargo just came out and finally came out and said, we don't think the Fed is, after all, going to be lowering interest rates this year. There's a whole bunch of people out there who've been thinking that starting in March, the Fed was actually going to start lowering interest rates. It's not on the table, but they can't get it through their thick skulls. So they keep trying to buy the market. So the bulls keep actively buying the market, try to push it up. But at the end of the day, what happens is some Fed speaker comes out and says, no, it's not going to happen. The market crashes right back down. And that's the stuff we're struggling with right now. So you got a lot of optimism in the market, and then the Fed comes in and crushes that optimism, pushes the market down. But then again, somebody else comes along and says, well, maybe a Jim Cramer, for example, at CNBC, he comes in and says, no, the market's going to spike 20% from here. And a bunch of bulls come rushing in again, and then the Fed comes in, crushes it down. And that's what's kept us in this narrow trading range. I don't know when we're going to get out of it. I know we're going to get out of it by this month. We may have broken out. We may be able to break out of it this week. I don't know. Friday, something happened. We'll talk about it here in just a second. Kind of makes me believe that maybe the Fed is onto something here, or maybe the market is onto something here, and maybe we can start taking action and get back into the market. But that's the reason I stopped trading. It's just simply the risk is too high. In fact, let's talk the risk here for a second. I've done a little bit of math over the last few days. So the trading range on the long-term trading range, and I'm not talking short-term stuff here, by the way. The long-term trading range for the S&P 500 is 4,350 to the upside, and then 3,200 to the downside. Now that's a wide margin, a really wide margin. But if you look at it, if you kind of narrow the math down, the likelihood of going up to 4,350 is only in the 10% range. So there's a 90% chance that we're never going to get to 4,350 anytime soon, not within the next 3, 4, 5, 6 months. So the likelihood of an increase or a steady rally is still, in my mind, fairly muted. There is a greater chance for going down here. There's a 19% chance that we could go all the way down to 3,200. Now, personally, I think I'm not going to say impossible. It's very unlikely. The Fed would have to come out and do something really outrageous to spook the market so much that the market would fall to 3,200 on the spider, on the SPY. Actually, I should say the SPX instead of the spider, because the spider is the ETF. But anyway, the market going down to 3,200 or 320 on the spider is almost impossible. But look at the numbers there. It's a 19% chance we get to 3,200. What are the chances we get to, say, 3,800, 3,700, 3,600? Those chances are even higher. So again, there's this fight in the market between going higher and the Fed trying to push the market down. Now, I believe the Fed is trying to push the market down. That's why I was so upset on Friday with what happened with the Atlanta Fed president. But the Fed has been trying to temper the optimism of the market. And the reason they're doing that is because they're trying to control the inflation, of course. Inflation is their number one goal right now. And inflation has started to reverse course in terms of it's kind of been going back up. Whether it continues that way or not, we don't know. We got some more inflation numbers coming out, so we'll start. We'll get information pretty quick on whether CPI, PPI, and PCE are going up again through the month of March. Having said that, they also need to start worrying about, or they are already worrying about, wage increases. Now, wage increases generally for employees are good, especially when inflation is high. But wage increases only happen when the employment market, the jobs market, is strong. Because normally in a recession, if you've lost your job, you'll take anything to replace your income. If you're making $50,000 a year, and I'm just going to keep it simple, if you're making 50 grand a year working a job and you get laid off, you'll take a $40,000 a year job as a replacement. Yeah, it's not as much as you were making, but at least you can make your mortgage payments, you can put food on the table for the kids, and you can pay the electric bill. So it's not a long-term solution, but it's kind of an immediate solution. That's what the Fed is shooting for. They need inflation in the jobs market to come down, and it's not. It's stubbornly high. In fact, it was a little bit higher in this past week than it was than what a lot of economists were expecting. While that continues, the Fed is going to have to continue to try to raise interest rates. I told you guys that I'd been thinking that the Fed was going to raise interest rates by 50 basis points maybe on March 22nd. I was pretty my optimism towards that was actually growing pretty steadily until Friday. So now I'm not so sure. But whether it goes up 25 basis points or 50 basis points, the point is it's still going up. So Wells Fargo was wrong that interest rates are going to start coming down and that give everybody the idea that, hey, I can get back into the market, we can start looking for stocks to buy and stuff. It's just not working that way. So there's a much greater risk of the market going down from here than going up. 10% to the upside, 19% all the way down to 3,200. But again, those are the extremes. The real math is somewhere in the middle. And that somewhere in the middle is right between about 4,100 on the SPX and to the downside about 30 let's call it 3,900 or 390 on the spider. The market's going to be stuck in those two ranges. And while all this talking goes on, we're getting these retracements, and those retracements are the things that scare me. I don't care about whether the market goes to 4,100 or 4,350 or to 3,200 because we can make money either way. What we can't tolerate, though, is that when the market's got a direction and then some Fed person comes out and says this, and the market tanks or spikes, and now you're like, what do I do? How do I fix that? Or and it never seems to spike in our direction, by the way. Sometimes we're in calls and they say something that makes the market spike down, and other times you're in puts and they say something and it spikes the market up. So we always seem to be on the opposite side of those spikes. But be that as it may, while the market's doing this crazy stuff, decided had to get out of it, kind of sit back and relax for a bit, and kind of catch our breath and see what plays out from here. But that's the reason why we didn't trade last week for the most part. Friday. Now, Friday, the market did rally. And it may be possible, and that rally, by the way, kind of set the table a little bit. There were some technical indicators that were solved on Friday's rally. Now, I don't know whether we're going to hold Friday's rally or not. There's a big part of my brain that says I don't think we can hold it, but there might be a chance for us to get back in the market starting tomorrow because of Friday's rally. Now, we're going to try to get back in the market this week, but I am going to be more judicious in the trades. And I'm going to tell you right now, guys, I'm going to go much shorter time frames. So what I'm going to do is when I'm up 10, 15, I'm just going to simply take the profit. I'm not, I may be giving up some longer term gains. For example, if I'm in 1,000, sometimes you get up 15 cents. You think, okay, let me hold it here. All my charts look good. Maybe we can get up to 20 to 25 cents. That would be 25,000. But right now, what I'm going to do is I'm going to basically go in, and if I'm up 15 cents, I'm going to take the 15 cents. And then if the market wants to continue going back up, I'm going to look for a new chance to get back in on the same side and try to avoid some of those retracements. So that's my plan going forward. Just going to have to take the shorter time frames to mitigate our risk as much as possible. We just can't stay in these trades very long simply because the retracements are just so brutal. That's the plan going forward. Now, I am a little bit more optimistic. Now, let me tell you why. The rally that happened on Friday wasn't because of anything in the market. It was because of the Atlanta Fed president. His name is Bostic, who gave his friends at the investment banks a gift. Now, you can tell I was a little ticked off when I wrote that, but he gave them a gift. And he promised no more than a 25 basis point hike going forward. Now, that flies in the face of just about everybody else. James Bullard out of St. Louis said we got to do 50 basis points. Fed president out of San Francisco said 50 basis points. I was leaning towards the 50 basis points. Now, I don't know how much pull Bostic has. He must think he's got a lot if he's going to guarantee the investment banks that the increase is not going to be any more than 25 basis points. That's sprung the market up. Now, it's kind of unusual to think that the market would jump up on another admission that interest rates are still going higher. And again, I'm going to go back to my original position. I don't care whether it's 25 basis points or 50 basis points, market rates are going higher. Now, what happened on Friday is that when this happened, the bond market, which had, the 10-year bond had gotten back above 4, fell down, came down pretty hard, because a lot of people are like, they're looking for any good news they can find. And of course, this was good news to them. So the bond market sold off a little bit. That forced the stock market to go up. Whether it's a true trend change in the market, I don't know. We're going to have to hold this. And if we can hold these levels and push it back up or get back up towards that 43.50, we may finally be out of the woods and kind of get back in the market as a whole again. But that's a big if. So at this point, we're kind of waiting to see what the Fed is going to do. Now, the Fed doesn't have another meeting until March 22nd, so we still have a couple of weeks to go before we're going to find out whether it's a 25 basis point move or 50. But based on what Bostic said, he's given the market some optimism that it's only going to be 25 basis points, and in fact, all future rate increases this year might be 25 basis points, despite the fact that inflation has kind of spiked a little bit again in the last 30 days. So he's promised those smaller rate hikes. Can he deliver? At the end of the day, I don't know. But that's the reason for Friday's rally. But that Friday rally did change some fundamental precepts on what we do in technical trading. So a lot of the technical charts picked up on Friday's rally, and we kind of solved some things, especially something called the 200-day moving average. So the market is trading well above the 200-day moving average, and that's usually a very bullish sign. Now, whether or not we can live off of that, I don't know, but it's not going to change how I'm going to trade for the moment, in that I'm going to go in, I'm going to be aggressive, but I am going to hold for much shorter periods of time. I just simply can't sit and hold for long periods of time. Maybe it's possible in the later afternoon if you see some of the charts, if you look at like an 11, 12, 13-minute chart in the mid-afternoon, those charts are pretty solid. I'm not saying they don't have retracements, but the retracements seem to be mostly in the morning or mostly in the evening or towards the closing bell. So that's where we're going to be careful. That's usually where I do my most trading, by the way. I don't trade a lot in the middle of the day because it's lunchtime and the markets aren't really driven that much. They may go up, but they go up very slowly. And again, the more exposure you have to the market, the more dangerous options trading can be. So we are going to mitigate risk here a little bit. Keep in mind, Jay Powell speaks this week too. So I think it's Tuesday and Thursday or Tuesday and Wednesday of this week. I may be wrong. It may be Monday and Tuesday, but if I'm correct, it's Tuesday. And I should have looked it up before I put this on. But he does speak. He's speaking before Congress. And unfortunately, when you speak before Congress, it's not a 5-minute blip. I wish they were 5-minute blips, but this is an all-day thing where he speaks for usually a couple hours each day. One day before Congress, the other day before the Senate, and they ask a lot of questions. And there's a lot of danger in there because you may not be paying full attention to what he's saying all the time. The next thing you know, the market spikes up or spikes down based on something he has said or something he's implied. Now, lately, Jay Powell has been a little bit on the dovish side compared to all the other Fed presidents. They've been doing most of the dirty work for him. I think that was planned. But what he'll say this week, we don't know. It does mean for a couple of days that the market might start out really slow, and everybody's waiting to see what he's going to say and how he says it. When it comes to this federal or these meetings he has before Congress, they usually do give a copy of his, he always has some prepared remarks first. They usually give a copy of those prepared remarks to the news media before he actually starts speaking. So we usually get a pretty good idea ahead of time what he's going to say. The hard part is the question and answer section. Once he does his prepared remarks, and then he goes into, where Congress people start asking questions. And it's those questions, we don't know what the questions are going to be. And of course, we don't know how he's going to answer those. That's where the danger comes in. But he does give testimony before the Senate House this week. So expect more volatility, but hopefully more transparency than we've been getting of late. I'm hoping he'll make clear what he thinks that the March 22. I don't think he's going to tell us, by the way, on March whether he's going to go half a point or quarter point, because they're not going to vote on it until that day or that week anyway. But I don't know where he's leaning. I would hope that he would tell us where he's leaning. I would hope that maybe he'd be a little stronger on his fears of inflation coming back. And we're still a long way from 2% inflation, which is what the Fed likes. And with the employment numbers the way they are and the wages the way they are, it's even harder to get back down to 2% than it is to watch these things come back up. So having said that, hopefully next week we'll have a pretty good week and we can get back to our normal updating all the financials and giving you an idea of what's going on in the market and all that stuff. But for the moment, I decided to be on the sidelines last week simply because the danger is just too high. So having said that, guys, if you have any questions, comments, or anything, just send me an email, send me a text, whatever. Other than that, we'll see you on the call on Monday, and we'll see what happens from there.